Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So on today's edition of Conversations, we welcome back James West of Evercore ISI, where we're going to discuss some of the new green technologies that he's been following, and him and his team, and really energy, now that it's back in favor after what feels like, what you said, two decades, I believe. Now, I'll let James introduce himself and we'll kick it off.
Well, thankfully, it feels like 2 decades, but it's only been 5 years. It was just a really challenging 5 years, and now we're back in vogue, and people actually believe we'll consume hydrocarbons again. So that's a good thing, and we think we will consume hydrocarbons for a long period of time. But as Mark mentioned, I'm at Evercore ISI. I cover the oilfield service equipment and drilling group, which I've done for a little over 20 years now. And we're increasingly moving into the green energy space and alternative energy space, as that seems to be the global push for decarbonization. So we've looked at hydrogen, carbon capture, and we're digging in more on wind and solar and things like that as they become more cost competitive. So there's a real trend in the market, a real trend globally to really establish more green energy as the world continues to transition.
Right. So, just kicking that off, looking at carbon capture, because I know that with what's going on in Texas, we've done shows on it. We have another report coming out on just what happened, and you have that base load the base load that has just been missing. Everybody was relying on those peak shavers. Peak went out. Now, that comes back when we start looking at coal again, and just based on what you've looked at and some of the interesting things with carbon capture, let's talk a little bit about what you've seen, what technology is out there, and is that something that could realistically be implemented and increase some of this base load with coal?
Absolutely. So, Mark, we've done a lot of work on this energy transition. Energy is always transitioning, but this is a new one, moving more towards some of the green technologies. And really, two of the really big points that I want to make that we've uncovered is, number one, even as we go towards net zero, we're going to be using hydrocarbons for many, many decades, perhaps more than a century from now. And that includes some coal, although coal will be less of the mix, but includes natural gas and oil. Now, oil demand could peak maybe several decades out and transitioning more to natural gas, as LNG is one of those transitional fuels. But that's the key. One of the keys. We're going to be using hydrocarbons. So how do we get to net zero if we are using hydrocarbons? Well, the biggest and most important mitigation pathway is carbon capture. So think about that as you've got a smokestack. I can put some equipment on top, use an amine chemical process, strip the carbon out. I can utilize that carbon if I'd like to, for beverage industry, for the food industry, or for enhanced oil recovery, or I can store that carbon. And storage is the most likely option. And in fact, here in the United States, we have the best storage options because we have the most wells drilled, the most depleted reservoirs worldwide, and that's where a lot of this carbon can go.
Now, when you're looking at the carbon capture side and going down some of these older wells, I mean, what is the process? Do we have to change pipes? Do we have to change compression? Like, what does that look like of going from that stack to a depleted well?
Yeah, so what we need to do to get it out of the facility is we're going to compress it and then most likely liquefy it. Now we can use trucks, we can use vessels, we can also use pipelines. Now, pipelines is somewhat of a dirty word in the U.S., so the ability to build a new CO2 pipeline, we already have some, Denbury has several, for example, but to build a new one may be a little bit challenging. But think about it as Denbury has pipelines in the Gulf Coast that run through some industrial facilities. Right now, those pipelines are underutilized, but as more heavy industry companies look to utilize those pipelines to capture their carbon, put it in their pipelines, obviously Denbury can charge them for the use of that pipeline, and then it would go to some storage facility unless it goes into EOR. So if it goes into a storage facility, you would have someone like a Schlumberger who would do the site work to understand, is this a reservoir that's capable of holding the carbon, and then do the monitoring process after the carbon is put into the site. So you'd have a fee for storing your carbon, a fee for monitoring your carbon. So this whole kind of carbon business is going to be developed over the next couple of decades, this carbon management business. And in fact, you've heard Oxy go on record as saying in 20 years, more than half their business will be carbon management.
Right. Now, when you're looking at, now for those that don't know, EOR is an enhanced oil recovery. Now, when we're looking at what this is and how this can be implemented in parts of the Permian, Eagle Ford, within, really in a lot of places in Texas, I mean, what kind of opportunities are you seeing or do you think could be deployed within that region in the near term as this technology gets implemented?
Sure. Well, I mean, the first is just putting the capture technology on the heavy industries that already exist in the Gulf Coast because they're feeding off of the either creating petrochemicals from the oil or they're feeding off of the natural gas for their own processes. So cement facilities, heavy industry in general. So we're already there. We're in Texas. There's no reason to take it somewhere else and store the carbon. So I think you'll see a lot of those existing facilities get retrofitted with carbon capture technology. The way it works, carbon capture costs anywhere from $60 to $120 per ton of carbon captured. Right now, there's a Q45 tax credit that if you capture a ton of carbon, you get basically $50. So there is an incentive. It's not quite there to fully incentivize because we don't have a carbon tax yet, and because we don't have a reason to capture the carbon. Right now, you can emit carbon for free. As soon as there's a pricing mechanism for carbon, we think that's going to catch on in a big way. And it seems like this Q45 tax change that recently happened, they went from $20 to $50. Now with some of the congressional actions that are coming down the pipe, plus the Biden administration's push on green in general, that we're looking at it maybe a carbon pricing scheme or some type of carbon taxes. And we're seeing carbon taxes at the local level. So for example, I'm sitting here in New York City. We have a carbon tax essentially coming in 2023. Now most people don't know this, because what they're going to do is they're going to look at all the buildings, both commercial and residential, in New York City and give you a carbon score. And if you're above some type of score, you're going to have to pay a fee. So I guarantee there's a ton of co-ops right now that have a boiler in the basement that have no idea that their fees are going to go up in 2 years.
I mean, and it's the other thing that a lot of people don't appreciate is there was almost a mini IMO 2020 vote throughout New England where you actually you can't run heating oil. It has to be ultra low sulfur diesel, and that's being adopted on a broader scale. So that's again cost. Like costs are going to go up because it's just more expensive to operate. Now, when you mentioned Occidental and Oxy sold there was, I think it was 2 million barrels of net zero carbon oil to India. Now, when you're looking at that, because there were a lot of jokes going around, but is this something where that crude could trade at a premium because you don't have to worry about it on the other side, and we could actually create almost a new benchmark for net zero carbon?
I think it is. I mean, I think if laws go into place in other countries that if you're going to consume a carbon product or the energy from that carbon product that it has to be net zero, then certainly a new pricing mechanism that's called the green fee essentially. Right. It's going to be higher priced. But what Oxy is doing is they're doing direct air capture of carbon too, so they can actually go from not just carbon zero, they can go to carbon negative and just be pulling carbon out of the air and then capturing all the carbon on their industrial applications.
Now, we've tried to talk to some of the individuals there, and they're still kind of hush-hush about what is happening, and obviously, there's only so much they can say. I mean, what are you hearing, or what have you spoken to some of the guys on the ground on the way that they can implement that, and what kind of testing facilities you've seen or heard about that would make this a viable option?
So you're exactly right. They're very cagey about it. They talk about it in general terms in their sustainability report. We're having a carbon capture summit on March 2nd, a virtual summit. I did ask them to participate. They're head of their low carbon ventures. He said yes, and then his IR team shot him down because they don't want to reveal the technology just yet. So we're aware of what they're doing. They are doing direct air capture. We know there's a lot of cryogenics involved, and then companies like Chart Industry are involved, we believe. And so that's kind of what they're capturing the carbon, liquefying it, and then storing it somewhere, or using it in their EOR most likely. So we know kind of what they're doing. I don't know exactly what they're doing, but we have an idea of kind of the grand scheme. Mm-hmm.
You mentioned Chart Industries, and it's been one of my favorites for years.
Yeah.
I've been able to invest in it profitably on multiple occasions, which has always been an even better side of the equation. But it seems like they've always been at the head of the table when it comes to these different pushes. They were the first to shrink and increase the efficiency of LNG. Right. Now they're sitting out there. I mean, talk a little bit about Chart Industries and is there new technology they've created? Can they use some of the technologies that they've had in both, everything from the cryo next to a hospital to an LNG side? Because they walk the industrial, the hospital, as well as the it seems like now carbon capture and the like. So, I mean, what are some of the things that you've seen or heard, and what do you think about Chart?
Chart's been one of our favorite stocks for a long time. We upgraded it last June after the big sell-off to start last year because it was one where we thought the business would hold up better than many people expected because they have a base industrial gas business. Now, the technology is continued to evolve over time, but it really still goes back to their original cryogenics technology that's many years, decades old at this point. Right. And it can be applied not only to LNG, but to carbon capture and to hydrogen, helium, other sources, all types of different gases. It's all the same process. You're taking a gas in a gaseous form, you're turning it into a liquid, and then you have the distribution and storage capabilities that Chart has. They sell you the tanks and the equipment to do that. They've done a number of acquisitions in hydrogen recently, several in water, around water sustainability. Right. And also they're looking at, they continue to invest in LNG, and LNG is taking off in places like India, where I think they announced a $60 billion program here recently in India. So they were already well positioned for this transition, but as Jill Ivanka, the CEO, recognized how quick it was coming and how fast it was coming, she very quickly repositioned the company to capture all these opportunities, and they're seeing them. I mean, their customer base is growing dramatically. So they had their conference call actually today, and they were talking about just the number of customers they've added just in the last year that are around all these new and emerging energy sources, not just the traditional LNG or industrial gases.
Right. Now, when we start talking about hydrogen, because there's multiple ways to make hydrogen in terms of green, was it green, black, gray, blue, all these different color-coded ways of describing hydrogen creation. But when you're looking at the hydrogen side of the piece of the pie of what this could be going forward, I've had a lot of conversations about, do you push the natural gas or water through the pipe and then they make hydrogen on the other side, because then you don't have to worry about the brittle side, because if you have too much hydrogen in the pipe, unless it's stainless steel, you can actually you have a brittle nature of that can right. come into the pipeline itself. So you have to do things to mitigate. You can either blend it with natural gas or other and then pull it out, or make it on the other side. I mean, what are some of the things that you've seen, or that you've, guys that you've talked to, of what are their positions and how are they looking at making hydrogen? So
there's many different ways that you can make hydrogen. And as you mentioned, there's blue, gray, purple, there's all kinds. There's really three ways you should think about it. And all hydrogen doesn't have a color. So it's really about the making of the hydrogen. So they're all the same thing. They're producing the same product, just in a different way. You have gray hydrogen, which is how we produce it now, which is causing the combustion of the natural gas and pulling the hydrogen out of that stream. You have what's called blue hydrogen, which is same type of, you're combusting some type of product using natural gas, and then you're capturing that carbon. And then, of course, you have the ultimate, which is green hydrogen, where the electricity is actually coming from wind or solar or some renewable power process. And so it's entirely clean, the whole process, and the only emission is water. It's water that goes into the atmosphere. So those are kind of the ways that you should think about hydrogen. The end goal here is to get to fully green hydrogen. Now, you have lots of ways to transport it. You can put it in pipelines, but only up to about 20% before you hit that brittle issues that you mentioned earlier, Mark. You can build new hydrogen pipelines, but you got to use stainless steel. And again, pipelines tend to be difficult to get built, at least in this country, it seems like today. You can also mix it with ammonia, and ammonia can carry the hydrogen, and you can put that into a ship. We did that recently from the NEOM project in Saudi Arabia. Ammonia took a shipment to Japan, for example. So that's already been done. They tested that out. They're trading new trade routes that way. So there's a lot of dynamics around hydrogen, how you produce it, how you ship it. There's going to be improvements in electrolysis technology over time, and so the costs are going to come down as a result of that. But we think it's an exciting world right now. We're heading towards a hydrogen economy. It's not like wind and solar, though. It's not cost competitive yet. We're talking $6 versus $2 for natural gas, $2.50 for natural gas. So it's got to come down in cost, but I think scale gets there, technology gets there. So while wind and solar, you can argue that their costs are competitive today, hydrogen's probably got maybe 8 to 10 years. So a lot of the projects we're going to see near term are kind of demonstration projects. So the economics aren't quite there, but they're demonstrating that the technology works, that we can use it, that it's safe. But as we scale up and as the costs come down for producing hydrogen, then we should come, just like wind and solar 10, 20 years ago, they'll become cost competitive over time.
Right. Now, when obviously we've had that conversation about natural gas, and then there's other talk of using water, but then the difficulty is it has to be distilled water, and if you use salt water or seawater, you have an issue where it corrodes the equipment, obviously because it has its salt in it. I mean, is that something that you think is a viable option, or do you think it's going to be more along the lines of a natural gas solution versus a water solution, given, water is a valuable resource and people have fought many a war over the lack of water in their country?
They certainly have. Desalination technologies are getting better, so we're able to create cleaner water. So I do think that water it's the ultimate option here, ex natural gas. But for now, we're going to, natural gas is definitely a contributor. But I think the idea is to get to more water over time, less non-corrosive water, so that you add some additional greenness to the project. The problem is you also got to think about sustainability, and water is is an item we want to have sustainability of, but we're also doing more work to get sustainable water as well. So it's a bit of a mixed bag right now, but I think ultimately water will be the way we go.
Yeah, the last question before we can pivot to some of the other technologies and then black oil, everyone's favorite. When you're looking at hydrogen, I tell the story that when I was 12, I went to the Javits Center and I saw BMW had a 7 Series that was run on a hydrogen fuel cell, and now I'm 36. And we're still at this stage. What is different this time? Like, what kind of things do you think have been progressed in that, let's call it a 20-year period, to see this innovation come through that is going to break it out on this go-around?
So I think it's a number of things. I think first off, the technology's gotten better. So we're able to produce hydrogen at a lower cost at scale. And so that's kind of number one. That's true with the other renewable types of technologies of electricity generation, so wind and solar as well. So those have gotten more cost competitive. So that's kind of an overriding economic force. The second thing is a lot of the rebuilding programs, post this pandemic, have a lot of green incentives in them. And most governments around the world, particularly Europe, China, and now in the US, really want a green push, and they really want to transition their economies away from fossil fuels. And so they're willing to put money where their mouth is and kind of drive this. And then the third is just societal pressure, ESG investing, a little bit of FOMO that's out there with companies that maybe don't believe in the hydrogen narrative, but they got to do it just in case it is going to work this time. Because you're right, we have had false starts. This one feels real. It looks real. And with the equity market, it seems like we're almost doing what we did with Tesla stock, for example. So Tesla, everybody's worried about Tesla going bankrupt, too much debt, too much debt. Well, you take the price up high enough, they can issue a bunch of equity, the debt problem goes away. So look at Plug Power. Now, I'm not saying they have a debt issue, but look at what their equity has done. The first time I talked to Andy Marcia about Plug Power was back in October of last year when we wrote that report on hydrogen. And he was one of the people we interviewed for that. He's the CEO of Plug Power. The stock was 12. It's 70 today. So are we doing the same thing? And he's issued a ton of equity along the way. So are we doing the same thing with hydrogen? And maybe we are.
Okay. Now, if for anyone that wants to learn more, James West and his team has put out some fantastic primers, so you can reach out to James or his team, and they can set you up with getting that delivered. So now shifting a bit, because wind and solar is now the soup du jour when we talk about Texas. And when you talked about some of the sustainability, but at the same time, we're seeing some of the limitations, and not that wind is expected to be operating right now, as they normally have a span of, in terrible weather, 7% is what ERCOT was expecting. Right. They typically go between 12 and 43%, depending on what is happening in the winter months. But wind doesn't blow as much in the winter. It's just inherent in the physics of how wind is created. But when we look at base load and we start looking at, like you mentioned the affordability of some of this and how some of the projects make sense, should we start factoring in what it costs to winterize some of these assets, or in order to make it more base load, factor in a bit more sustainability on the natural gas peak shaving of those short cycle guys? Because it just seems like everybody was relying so much on these peak shavers that just couldn't operate in this type of climate.
Yeah, this was a very unfortunate event, and people are still suffering today from what's happened in Texas. And I think that it's kind of a little bit of a once-in-a-generation type of of event. I think we need to invest in the winterizing of the equipment because the wind was blowing in the Dakotas and they generated power. It's blowing in Canada and they use wind power there. So you can winterize the equipment. It is an incremental cost, but it probably should have been factored in here because when you do have this kind of cold weather, you're right, the peak shavers, the natural gas peak shavers don't work either and everything freezes. And so that was unfortunate, but probably should have been considered as they planned this out to have a better sense for base load, and also they need to put more storage. There needs to be more energy storage. Energy storage is going to explode as a part of the market going forward. And it's all going to be lithium-ion batteries most likely and some other techniques, but energy power storage from renewable sources, it's already big in California and in Europe, but we're going to need to put it everywhere else if we're going to generate renewable energy because the wind doesn't always blow. And particularly with solar, the sun doesn't always shine. And so, with solar, we're seeing a trend towards the power storage is about 50% of nameplate capacity. With wind, it's about 10% because wind you do get kind of 24 hours a day, but solar, you have half the day or less.
So now that when we think about the Northeast, so for James is in New York, he knows what the winters of 2013 to 2015 were, and when we did a breakdown of how we could have increased the sustainability of our grid, there was a push for that dual fuel mandate, where if you were going to be base load on a natural gas side, you had to have diesel. Like, let's be fair, it's just we can't lose power, and we have to have up to 2 days worth of diesel storage. I mean, is that something that you think is going to be a viable option given the push towards green, where, like you said, it's once in 100 years, which unfortunately with climate change is becoming a little bit more frequent in terms of the extreme weather conditions and let's be honest, it's Texas. There's a lot of diesel laying around given the refining complex. So it seems like it's a way to help some sustainability of the grid itself to mitigate some of these issues.
Yeah, I think you're exactly right. There needs to be some type of more base load, and of course those winters propane prices went through the roof as well. I think we've got problems with the grid in the Northeast. I think we have political issues as well. As you know, Mark, we could source more natural gas from Ohio and Pennsylvania if they let us build pipelines, yet in Boston they have an LNG terminal, so they're bringing in LNG. It makes no sense geographically. This is the way it's lined up. So you got a lot of political action that's stopping some of what should be energy progress and creating a better, more sustainable grid in the Northeast. In fact, I think the hurricane last summer was actually a good example where it knocked out power in Connecticut. I was actually down in North Carolina, and it didn't hurt us bad. We lost power for a day, but we don't have a lot of trees on the beach. So it got to Connecticut, a lot of trees, power lines went down, and I had buddies of mine that were in Connecticut that had lost power for 5 days and didn't have generators, and of course generators went in short supply very quickly. So there's a lot of issues around the grid in the Northeast that need to be worked out and need to be resolved. It's kind of the biggest concern that doesn't seem to be a big concern to everybody. As we go greener, we need to fix our grid. I was watching something the other night where the host of this show was talking about if Thomas Edison woke up today, he would recognize the grid because it's basically the same grid that he invented. And the grid itself, as you know, only goes one way. The power goes out, it can't come back in. And that's a big issue. That's why we need the storage capability so you can manage your own power consumption. They do a lot of that in California already and in Texas.
And there's other sides to that as well. When you think about how we're asking the grid to consistently do more, when you look at New York, as you were talking about with some of those fees coming in, there's that push to have an electrification mandate, whether that be for heating and or more electric appliances. And then obviously we have the push for that EV or the electric vehicle, which is, again, all of that is not saying that it's inefficient, but it's again a bigger drain on the grid, which comes back to the question of how are we going to provide base load that is sustainable as well as reliable and redundant. And I think those are the two key things here.
I totally agree with you, and I think we need to create a market that looks more like the European market where countries can trade power when they need to. So we can do that. We should be able to do that within states. Now, Texas, as a great example, they're contained within Texas. Right. And so you look at next door, they've got power, and because they're trading with other states. So if Texas didn't have its own grid contained to themselves, they wouldn't necessarily be in the same type of situation they're in now. The Europeans do that very, very well. So when it's beautiful and sunny in Spain, and they've got power they need in Germany, they can give it to the Germans because they have excess power in Spain. Yep. When wind's blowing in Denmark, they can ship it down to France. So, I mean, those are the kind of things that they do in Europe, but that's more of a smart grid solution. There's a lot of talk about the smart grid here. We just haven't implemented a smart grid yet.
Yeah, and that comes to, and we've had conversations around what is a microgrid versus a regional grid versus, because it comes down to rate base. How are you going to push that rate base in different directions and expand it across a larger pool of people so you don't have those rate spikes in general. So there's a lot to talk about, and we could spend hours on discussing the grid and the failings and some of the solutions. But now getting back to where we are, obviously crude has had a tremendous rally. We've had energy stocks that have gone up 50%. I mean, are we looking at this and saying it's going to pause here? Inflation is real, and these guys were front running inflation, or are we just getting started and there's more meat on the bone?
I think we're actually just getting started on crude, and the reason why is number one, demand continues to grow. You could look at China and India right now; their demand's above where it was last January, as they've kind of reopened, especially China. You look at just crude consumption globally at 93, 94 million barrels a day. I'm sitting here in my apartment. Doesn't feel to me like the world is 7% shut down. Seems like it's a lot more shut down. There's a lot of pent up demand that's out there. So I think we're going to come back into supply and demand imbalance very, very quickly. The Saudis will then put oil back on the market, as well as probably some from the UAE and Kuwait. And we'll get back into a market that's not driven by fiat, but more driven by pure supply and demand. And then we're going to figure out two things. One, North America is not going to grow. The E&Ps are being forced to live within their means. They've never been able to grow within their means. And if they're going to give 20% of cash flow back to their shareholders and spend 80%, well, the oil price is going to go up as a result of North America not being that spoiler that it's been the last decade or so. And then the second thing is we haven't invested in the international markets and international production in 5 years. So we're behind. We're behind the curve there. And these markets need investment. We're going to see a pickup in investment internationally, but it's going to come too late. Because these projects especially offshore, take at least 2 to 3 years to come online, in some cases 5 years. Onshore, you get some short cycle barrels faster, but you got to start cranking rigs, you got to start spending. And I think the NOCs will step up and do that. I think some of the majors will continue to spend. They'll talk about how they're buying wind farms and going renewable, but they'll have deep water rigs running around the world as well. And then some of these independents that kind of got themselves into more shale plays and more shale focus, they're going to try to spend money if they still have international acreage, they're going to try to spend money on that international acreage to get production back up because there's going to be a call on production. The call on production is always, as you know, Mark, the oil price. Right.
Now, when we look onshore, like as you talked about with the U.S., I mean, we've been looking at horsepower, and coming into this year, we kept saying that even if there was demand, we were going to hit a horsepower problem as we crossed over that. We estimated between about 230 to 250 spreads before all of a sudden someone's Pioneer is going to call up and say, I want a spread, and people are going to be like, yeah, well, there's no horsepower. So then, are they willing to pay up, or is there, when based on what you've heard or what you've seen, are we right? Are we wrong? Like, what are you seeing, hearing in terms of that horsepower crunch?
We're right there with you. So if we actually upgraded Liberty and next year based on this assumption that it will be a short squeeze on horsepower, and the pressure pumpers will get pricing as a result of that. So we think that the number of spreads in the U.S. has gone from a peak of maybe 500 and is now at about 270 availability, so 13.5 million horsepower. The spread count today is somewhere in the 160 to 170 range. Obviously, we look at the numbers you guys have. We look at others as well. They're all pretty consistently around that range. When we model it out, we think you need 225 minimum working kind of 100% of the time. So no repairs, no maintenance to keep production flat. So that would argue that you need more than that in the market. And then there's a situation developing now where the system is getting two-tiered. So you had the 25, 30% of the horsepower out that's dual fuel equipment, so ESG friendly, that's sold out. There's no more availability of that. Now, Halliburton, I think, is bringing some converted fleets back in, maybe 4 or 5, but not a ton of those that are dual fuel. So those we'll get some more here near term, but not enough to satisfy the ESG mandates of these E&P companies. So they're going to have to go back to the older diesel run, pure diesel run technology. And once you get to that 230, 240, especially with about 50 of that 270, we think are really just cold stacked, and we don't really know what the equipment quality is, and can it go back to work in a month or 2 months, or is it 6 months because it needs some repairs? We could see a pretty quick squeeze on pricing, and pricing could go up very quickly. And you're already seeing a little bit of pricing power. It's more of a pricing they gave up because the customers needed a price decrease, and getting a little bit of that back right now. But once that's that first phone call where you can't get a spread, all the pumpers are going to talk about it, and they're going to raise pricing. It's going to happen. It happens every time.
Yep. Now, when we're looking at, Liberty is one of our favorites in terms of the way they've managed it. The Schlumberger deal was very good. There wasn't all that much crossover, so they were able to expand. But one of the things that they've talked about and others is the dual stimulation, and we keep hearing about it, and we're starting to see it adopted more. Now, is that something that you think can be deployed across a broader spectrum and would bring down some of your estimates on how many spreads are needed to keep production flat, or do you think that's kind of a something that's been talked up but not as real?
So we've been doing that for 5 years. It's not new. It's getting a lot of talk right now, and it is, the adoption is going up. So, but Halliburton's been doing this for 5 years. So I think that it does change the numbers a bit. I'm not convinced it changes it a lot. I think a lot of the geological issues that we're going to face this time, because we've drilled most of the good wells, as you know, in the Tier 1 acreage, I think that offsets some of that too. So you're going to need to just complete more wells to get the same amount of production. So there's a bit of a push and a pull there, where I don't think my 225 or 230 all of a sudden becomes 180. Maybe it becomes 220 or 215, but it's not that big of a deal.
Okay. Now, when you mentioned some of the investments abroad and some of the places that you could see some opportunity, I mean, what are some of the locations that you think some of these NOCs and maybe even the IOCs would actually get active in trying to invest in?
Yeah, that's a great question. I think that the areas where the IOCs are probably most focused, of course, are going to be Suriname, Guyana, and then Brazil. Brazil's got excellent geology. They've opened up. They've lowered the local ownership requirements and local content requirements. They're beyond, car wash is now kind of behind us, at least we believe for now. And so, unless something pops up, and it always does, but still, I think we're off to the races in Brazil. And then I think the majors will continue to exploit West Africa and East Africa for natural gas. So I don't see them pulling back from a lot of these projects. I mean, they do understand LNG, or natural gas, is a key transition fuel for the next 50 plus years. So they want to be involved in that. I think with the NOCs, certainly the NOCs are going to get active in all across the Middle East. Saudi will ramp back up. They will want to have that, continue to have that capacity to produce. We do think North Africa is becoming a little bit more interesting now as well, and the stability of the region is getting better. And then you're going to see all across Southeast Asia. You have gas projects in Vietnam. You've got China has a real national strategy to stem their production declines. And then, of course, you've got the LNG in Australia and other things around that part of the world. So we really see it as a global phenomenon. I didn't mention the North Sea. The North Sea's been active the whole time, and there really was no downturn in drilling the North Sea. But certainly they'll continue to drill and expand in the North Sea, while also that's one of the more interesting markets for carbon capture, because they're taking carbon prices to $240 a ton. So they have to balance that. But very interesting stuff happening in the North Sea. And of course, Norway is the biggest gas supplier to Europe, so they want to continue to be that supplier.
Yeah, when we look at, there's been a lot of investment that we've seen or talked about in terms of the UAE, Saudi, Iraq has seen some, and then obviously they've announced different fines that are next to some of the other ones. So when you talk about some of the projects coming online, when you look at offshore and some of these other ones, typically it's 5+ years when you're building out, but you mentioned, that 2 to 3. Is that because you're factoring in that they can utilize some of this, equipment that is underutilized and can come to market a little bit faster and cheaper versus some of the other options?
Yeah, I told a group of deep water executives back in early 2015 at a conference in London that they had to change or that deep water was done. And I showed them the economics of short cycle shale, which they actually weren't as good as we thought they were at the time, but so shame on me. But I told them basically, you got to fix your business or you're out. And I got off the stage, I remember, and I got surrounded by like 15 guys, and I said, "Oh no, this is not good. I didn't mean to be that mean. I'm just telling you." Yeah, I started the pot, and they all said to me, do our CEOs know this? Because we agree with you. We got to work together. We need to combine companies in certain cases. We can't have 50 cooks in the kitchen. It doesn't make sense. It takes too long. The delays are always change orders. That's the problem. Right. So you look at what FMC has done and having the full kind of delivery system with the equipment they got from Technip, and of course they're now spinning back out some of the E&C assets, but they're keeping the boats. And so they delivered in the North Sea a deepest water project in 22 months. That's the fastest one ever. They're talking about one they can do in 20 now, but so we're getting better. And there a little bit of that's underutilization of assets, and we don't have a squeeze on people and equipment, so that will lengthen out. But what we saw last cycle is the lengths went from 5 years to 10 years, and shale went from a couple of months to a couple of weeks. So they were going the wrong direction. This time I think it's much more viable. Your time value of money is not as much of an issue. Your cyclical risk isn't as much of an issue as well, because you get to first oil faster.
Right. Now, the complexity of the next question is always going to be at what is OPEC Plus going to do when we look at, obviously Saudi took the 1 million barrels a day off the market. Now they're talking about bringing back 500,000 or so, or starting to unwind that. I mean, there seems to be some difficulty or strife, as there always seems to be, between Russia and Saudi and the GCC in general. I mean, when you're looking at this type of agreement, because there's a lot of cooks in that kitchen, I mean, what are you expecting, or what are some of your base cases for what OPEC does over the next few months?
Well, I think March of last year was very telling. When OPEC Plus fell apart, the Russians said, okay, we can produce what we want, and the Saudis declared market share war, took pricing down, put a lot of oil on ships, then of course the world shut down a week later, and so the oil had nowhere to go. We all got concerned about topping out in Cushing and places like that we wouldn't have storage capabilities. Now that all didn't come to fruition, we'd shut in wells and stuff, and so we got past that period. But I think that was at least a mark, an event that the Saudis and the Russians don't want to see again. Right. They're very cognizant that wasn't good, so that relationship was partly repaired. Now the Russians do want market share. They do want to produce more hydrocarbons. The Saudis want price. And you saw that at the last meeting where the Saudis unilaterally let others increase production and took 1 million barrels off the market. And now they're putting those 1 million barrels back on. But I think that's the way it's going to happen. Russia's going to top out in terms of production here relatively soon. They only got a couple 100,000 more, at least according to our estimates. And so all that spare capacity really rests within Saudi and a little bit in the UAE and Kuwait. But we do think that those barrels are going to come back on in a reasonable manner. That Saudi's going to be rational about how they do this because they want price more than volumes right now. And as that'll probably continue, I think, for at least the foreseeable future. So it is OPEC. You can't always say they're going to be nice forever. A lot of these countries don't really like each other. They don't get along. But everybody's best interests are at heart. I think the one thing that it could be a concern is if the U.S. Does rejoin the Iran deal and Iranian barrels come back. Now, how fast they come back is a bit of a question mark. The company that does all the service work, most of the service work in Iran was Schlumberger. It's the Schlumberger business. Schlumberger had to divest and they had to leave Iran. It's called Iran Well Services. They've got good technology in the country, so I think they can come back. It's just a question of, is Biden going to make that move and go back in? And given what they've done on the nuclear side, given what all the poking around they're doing in the Middle East, I'm not convinced it's a near-term event.
Now, you bring up some good points when you were talking about Asia specifically on some of this recovery, and distillate is starting to get there. Gasoline is already there, but it's really LPG. We've seen propane remain strong. The recovery was almost instant, and now we've been in pure growth. We've seen that in a naphtha market, and when we look at the U.S. and the amount of NGLs and liquids in general that we produce here, what about, and I know it's the ugly stepchild of the oil barrel, but And the NGL basket is priced fairly strong, and it seems like there could be some stickiness because obviously it trades off of oil, but it's been able to outperform. But obviously it's on the back of ethane, and with as you know, as ethane recovery can increase, and then all of a sudden that normalizes. But it seems almost like there's a little bit more behind it now because that international demand is there. I mean, how does that kind of factor in with some of your estimates on how much activity can we get in the U.S. and some of the other regions that have that liquids rich portfolio?
I think you will see, of course, increases in activity. The Eagle Ford, for example, a good NGL area. And so I do think you will see people targeting that because those prices do appear, at least in our minds, to be sticky. There could be some bumpiness because they came back so fast that maybe the market does have some hurdles to get through. But overall, we think higher for longer, especially with things like propane, is clear to us based on the dynamics, particularly in Asia, the pull from Asia and the supply that we've constrained somewhat here with our rig count decline.
Right. Now, when you're looking at some of the activities abroad, I mean, how does that factor in for Nabors? I'm always curious as to what people are thinking about when they look at Nabors, the fact that they have the joint venture with Saudi, there's they're starting to get back. I mean, is that something that is going to be beneficial for them in the long term and have some headwinds in the near term?
So near term, there are headwinds, but long term, it's a fantastic joint venture. The way it's structured, they get a return on their investment in the assets, which in the oil business we haven't always gotten returns. So the fact that Aramco owns half of it means when Aramco flexes down, the last rig to get laid down is the one that's in the JV. When Aramco flexes back up, the first rig to go to work, that's in the Aramco JV. So I think overall it's a net positive for them. I'm not sure investors understand the true value of the JV at this point. I think there's still this perception on the debt side that they've got too much debt, even though they've turned out a lot of the debt and taken advantage of debt markets when they've been open, and they're generating cash. It's trading like a distressed asset. It's not really a distressed asset. So I think people are more focused on the leverage profile there for Nabors rather than the fact that they've actually got a very good international business that is going to come roaring back when Saudi comes back.
Now, when we look at the international versus domestic business, some of the contract structures were changed to be linked to Brent, and now obviously we have Brent trading at about $64. I mean, is this going to be some of the tailwind for some of the guys that have bigger international markets versus U.S. markets in terms of margin expansion of that thing that we like to talk about but we haven't seen?
Right. Well, we do that when we go into downturns. We link them to Brent, and then for some reason, when the upturn arrives, that linkage goes away. They never honor the contract. And, so I don't really think that's the driver. What I think is the driver is going to be is the lack of investment by service industry over these last 5 years in equipment in those international markets. These markets haven't seen volumes. And so as you see volumes go up, there's not a lot of equipment. Equipment's going to be scarce. We were already talking about pricing gains at the end of last year. So we were pushing pricing then. We're about to be back to activity levels in the back half of this year that looked similar to the end of 2019 or 2020. And so if that's the environment, we're already talking about pricing gains. All the big three main players, Baker, Schlumberger, and Halliburton, have all agreed to the OFS pledge. They're returns focused, they're cash flow focused. They're not going to go out there with aggressive pricing. I think pricing goes up from here. I think there's a good opportunity that we actually finally see that margin expansion that we talk about.
That we all talk about, we'd love to see. It just seems like like you said, it's all starting to come together, and there's that opportunity for the upside for sure. And then when some of the just to wrap up a bit, I mean when we're also talking about some of those renewables, there's also talk about that happening in the Middle East, and what are the companies that are active over there? Occidental has a certain amount of relationships. Is that something that could be an expansion area once they start testing and proving out some of the technology where they could almost diversify even more into another market?
I think so. I think that's clear that the Occidentals of the world, which is kind of the national oil company of Oman, they see those big opportunities for them as they scale back on their U.S. operations and understand the profitability of shale is lower than we thought it was. And so I do think these independents that have that opportunity, that ability, are being welcomed into these countries. They need some of the technical help. They want some of the expertise that we learned in shale. They want to get better. And so I think there will be some of that technology transfer, and therefore they'll be inviting companies into those markets. Particularly the Middle East seems to be embracing it more so than other countries, but that's where the oil is. So we'll take that.
Right. Now, last question and last topic before we let you get back to your day. When we're looking at LNG, you talked about LNG, the investments in parts of East Africa, but obviously Qatar is the big one there. And Qatar has some limitations with Iran, but they've brought on some new capacity and they're looking to build out in general. Then you have Australia, which has had some issues with gas shortages, depending on which part of the country that we're talking about. Right. So there's some opportunity, but then some pain and shifts. And when you talk about Russia, we have Yamal. They're looking to build out even more. I mean, where are some of the growth profiles, and what are some of the companies that you think are well positioned to take advantage of some of this international LNG build out?
Well, so on the LNG side, clearly the guys that make the equipment. So Baker Hughes, basically 100% market share for turbo machinery and LNG facilities. Chart Industries gets a piece of basically everything that's out there on the LNG side. Technip Energies, which was just spun off, they are the main construction firm that does LNG. So they're going to get the stuff in Qatar. They're going to get Russia, but they've been successful there. I think there is that Australia issue where if you're in the wrong part of the country, you can't get the gas that we're shipping out. So again, it's the unintended consequences, right, or not thinking the whole country through. But I think over time they can resolve that. So we do think those are the three that I would talk about. And there's other kind of LNG players that are out there as well that well that or know better than me that'll capture some of this. But LNG pricing has now gone back through the roof. So we're back at a very much tighter market for LNG. So we do expect FIDs to pick up for a lot of these new projects, particularly the ones on the Gulf Coast. Right.
Well, it's funny, we've whenever we talk about LNG, I've always said, look, $6.50 to $7 landed FOB into Asia is kind of my base case of that's what it's going to be on a blended level. And as it was trading $4, people said I was crazy. And now that is trading, close to 20, everyone's like, oh, you're too low. It's like, no, it's a seasonal. There's going to be peaks and valleys, but we just have to think about what are the economics in general. And then you see, and speaking of Japan in general, they've talked about building 22 coal-fired facilities just because they're looking to get away from some of this nuclear capacity, and it's just going to be a matter of can they layer in some of that carbon capture, because it is interesting in terms of, look, we have to do this for that base load. It's consistent. Australia has more than enough coal. We can bring it in. They obviously have their issues with China right now. But there's also that LNG capacity, so they can blend it, I think, in a strong way, and it'll be interesting to see how this all plays out in general.
Well, it's interesting you bring up Australia, because Gorgon, tough, difficult capital investment, should have been $30 billion, ended up being $56 billion, I think, or $57 billion. But carbon capture was key to that, to the Australian government. So Baker put in a lot of carbon capture when they were helping construct that facility around their turbine system. So I know that played a big role in Australia. Expect that to play a bigger role going forward for LNG.
Okay, great. Well, thank you for the time. It's always a pleasure catching up and hearing what you have to say.
Well, Mark, you should know you got a couple really positive shout outs on a meeting on Clubhouse, that new app last night. So people were talking about you. I don't know, like 200 people in the room. I just got the app, which means it's not cool anymore. Okay. That I have it. So I'm pretty sure you know about it or been invited to it, but you were getting a lot of shout outs, so it was nice to hear.
Well, I appreciate it. I was actually invited to speak about on the app, but I actually don't have an iPhone. I have one of these Google things.
That's what Chuck said. That's right. Yeah. That's what he said. He's like, he didn't have an iPhone though.
So. Yeah, apparently I'm the only one, because as you said, there's 200 plus people there. So they don't have power, but they can get on their iPhones.
Yeah, exactly. So now when you get the app, we'll know you have an iPhone, which means iPhone's no longer cool too.
Exactly. So I can be the tell on when you should sell Apple in the market.
There you go.
All right. Well, thanks again
Mark.
for your time.
Having me.
It's been a pleasure.
Thanks. Good to see you.
Good to see you. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Thanks again for watching. If you have any questions, concerns, comments, please let us know in the comments. You could reach out to James and his team at Evercore ISI. So thanks again for watching.